Hi everyone, welcome to today's webinar. Just let me know in the chat if you guys can see me and hear me. Okay, great. You guys can hear me, that's great. Hi Risa, how are you? I'm doing good. Okay, we'll begin the webinar in about 2 more minutes. We're just gonna wait for more people to join the session before we get started. Yep, so today it's just me. I'm Melanie, so I'll be your speaker for today because Peggy isn't feeling well. So I'm just covering her for today. She'll be back next week, hopefully. Yeah, so if you guys have any questions throughout the webinar, feel free to let me know in the chat and I will try my best to answer you guys. Okay, let's go ahead and get started. So welcome to today's webinar. Today we're talking about harmonic trading strategies, and this will be our second part. Okay, so as per usual, just a disclaimer. Any information contained in this webinar should not be construed as advice and is presented as educational material only. International Capital Markets Private Limited has not considered your objectives, financial situation, and needs, and you should consider its appropriateness to your circumstances. The contents of this webinar and any accompanying material are not intended to be a solicitation of funds or recommendation to trade a financial product. Any opinion shared by guests and speakers of the webinar not necessarily reflect the opinions or views of IC Markets. Okay, let's get started. So I'm your host, I'm Melanie. I'm from Everest Fortune Group, and we were finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. So here's our agenda for today. I'll briefly go through a intro of harmonics just in case you missed our session last week. And then we'll go through a recap of Fibonacci as well. So if you guys were here for our Fibonacci series, that's great. So I'm just gonna quickly recap because you can't really use or understand harmonics fully without Fibonacci. So that's really important. So I'm just gonna do a really quick recap on Fibonacci. And then we'll look at market structure and we'll delve into the different types of patterns. Okay. Okay, let's get started. So harmonic patterns are a popular trading strategy used by technical analysis to identify potential price reversal points in financial markets. These patterns are based on Fibonacci retracement and extension levels, which are basically mathematical ratios that traders believe are significant in determining potential support and resistance levels. So harmonic patterns The foundation was laid by H.M. Gartley in this picture here in 1932, and it was later developed further by many authors such as Scott Carney in his books of Harmonic Trading. Okay, so harmonic patterns reflect geometric price structures, so such as retracement and projection swings or legs, and that's why we're going to do a brief recap of Fibonacci because it's basically the core of harmonic patterns. So these adhere to Fibonacci ratio relationships. In other words, retracement and projection price swings that form these patterns are interlinked together based on specified Fibonacci ratios. Okay, these harmonic structures exhibit unique price movements and key turning or trend reversal points. And this factor is very helpful in trading as it provides highly trustful price entries and key levels for targets or stops. Unlike other trading methods, harmonic trading attempts to predict future movements, and this is what differentiates it from other indicators or oscillators and how they work. Okay, so I'm just going to go through some basics for harmonics. So we have the reciprocal AB equals to CD pattern. So for this pattern, if you take a look at the image on the left first, the classic ABCD pattern, you can see that the AC line is a retracement, a 61.8 to 78.6% retracement of AB. On the other hand, CD or BD rather is a 127.2% to 161.8% retracement of BC. Okay, um, if we're looking at this chart on a time in terms of the time periods, the time of AB would be equal to the time of CD. So basically this distance from A to C would be equal to the distance between C to D. Okay, and on the left or on the right over here, I've included just a table for you guys to take note of the C point retracements. So if you recognize these levels, these are your basic Fibonacci retracement levels. And the D point basically tells you where or how much your levels should retrace for the BC to be considered as an example of harmonic patterns. So you can see here, for example, I'm going to take the very first 38.2 retracement. So if the C point retraces 38.2, you can expect the D point to retrace 261.8% of BC. Okay? Okay. So how exactly do we find AB equals to CD? So this is just a number of steps for you to follow if you're looking at finding an equal length between AB to CD. So firstly, we have the retracement of C, which will determine the end of D point. So retracement of C here, and then we can project D to be somewhere about here. So to get your D point, you would draw a Fibonacci extension from B to C. Okay, from here to here. So you draw your extension from here to here, and then measure from A to B. So from this line to this line, this points whether we can use a Fibonacci expansion. So if you're confused what the difference is between an extension and expansion, I'll get into those just in a little bit. And lastly, end of significant D point zone should have support or resistance or demand and supply, etc. So this basically means that if we're looking at it on a chart, so on a candlestick chart or a line chart, we should see that this D point should have previous points that give us a support or resistance level to show us that price has respected that area in the past. Okay, so that's how we determine whether the D point is significant or not. Okay, so this is an example of a harmonic retracement on the left, I've labeled a couple of shapes at the bottom, so a number of types of harmonic patterns, but we'll get into those towards the end of the webinar after we've gone through the retracement, just so that we clear things up on what exactly we can look out for. So firstly, harmonic retracement, this is the shape that we're looking for, kind of a W shape. And we're expecting price to retrace at least 38.2. So for this kind of shape or this kind of retracement, we can use the Gartley or the bat shape. Okay, for harmonic extensions, we're looking at price exceeding the original height of the first point. So in this case, it would be point X. Okay, and for this extension, we're looking at alt bat and butterfly and crab. And we can expect it to retrace 113 for 113% for bat and 127 for butterfly and 161.8 for crab. Okay. Yeah, I'll show you guys examples later on. Okay. So now let's get into our Fibonacci recap. Just in case you were wondering what exactly am I talking about in the first few slides. Okay, so firstly, we have these different types of Fibonacci retracement levels. We have the Fibonacci expansion, which I mentioned earlier, and these constitute the negatives for your Fibonacci levels. For Fibonacci retracement, these are the points that are between 0 to 100%. So you can see these 5 levels here. For Fibonacci extension, we are using those levels above 100%. Okay, and if you take a look at the GIF that I've included here, this basically shows you how you can draw a retracement level. So it's important to always follow the market structure or the shape of the chart. Okay. Okay, so I've included a couple of GIFs here for you to take a look at. So for retracement, that's the same GIF that we looked at previously. For expansions, we are looking for this flash kind of shape or like a lightning bolt shape. And we are looking for the negative levels, as I mentioned earlier, minus 27 and minus 67. So basically, we draw the expansion lines from the starting point to the ending point. That's how you draw an expansion. And then we're expecting price to continue to move upwards towards this negative 27%. Okay, and react off of that. And if it doesn't react off of that, then we're expecting it to continue and react off of the next level, which is negative 67. For projection, I will get into that in a bit. I'm not sure why my GIF isn't showing up here. But for extensions, that's also what we call our Nike tick. So if you can see here, I've drawn out the Nike tick shape. Okay, we are measuring out the starting point and ending point, and we're looking at 127.2% and the 161.8%. And we're expecting price to continue upwards and either play off of the 127 or off of the 161.8. So that's basically the 3 different retracements in a nutshell. Okay, so once again, here you can see all the different Fibonacci numbers that we mentioned in the previous slide and how it looks when it's drawn out. So maybe you want to take note of the starting and the ending points of the Fibonacci trend line. So the mid-range are the retracements, negative are the expansions, more than 100% are the extensions. But in all of these 3 Fibonacci scenarios, we are using only one tool, which is the Fibonacci retracement on MT4 or TradingView. Okay, so we are following the pattern, or we're following the chart, the shape of the chart really closely when you draw out your Fibonacci trend line. Okay, Next, here's an example of the Fibonacci retracement method. So we can see in this example that price bounced off of this highlighted area over here. And it's also in line with the 61.8% Fibonacci retracement. Okay. Okay, here's another example. We have a Fibonacci retracement, but now price is bouncing off of the 38.2% level, and this dotted line is also a significant level because we have bulls and bears that are respecting this area. So if you came for our support and resistance webinars, you would know that this is called an overlap support because we have a swing high and a swing low that line up at the same level. So that's what we call an overlap support. And this overlap support lines in nicely with this 38.2% Fibonacci retracement. And that's why we've highlighted it because it's a significant level. So we can expect price to continue to react off of this level. Okay, next, we have another example for Fibonacci retracement. In this case, we are using two retracements. Okay, so notice how in the big Fibonacci retracement trend line, price reverses off of the 61.8% Fibonacci retracement level. So where it's highlighted here. Okay, and then once it's reacted off of it, our next trend line is from this line, this point, this swing low, to this swing high. And once again, 61.8 is the level at which price reacted off of. Okay, so now let's get into Fibonacci expansions. So this is an example of how it plays out, okay? So the starting point is here at point 1, and it retraces the mid-range and bounces back up. So you can see the arrows or which follow the price movement. Okay, this forms a flash shape or lightning bolt shape, and that's basically what you're looking for expansions. And we can see firstly we have a retracement since price retraces 61.8. Then the expansion comes at the bottom here, at the negative 27 level. Okay, and this is where price comes down to and where we are expecting it to bounce off of at that support level. So here's what happened after that. We see price react off of the 61.8% Fibonacci retracement and ultimately bounce off of the negative 27.2% Fibonacci retracement and rise back to the ending point. So pro tip is that price usually comes back to this ending point of your Fibonacci trend line. Okay, usually bounces off your expansion line and then it hits back and reacts off of that line again. And the reason for that is, if you remember in the previous slide, I mentioned an overlap support. So this is, in this case, an overlap resistance. And that's why we can expect price to reverse off of this level again. Okay, next let's move on to Fibonacci extensions. So for Fib extension, here's an example of price reacting off of the 161.8% level. Okay, remember for extensions, I called this a Nike tick. So you can see here really clearly the head of the tick and the tail. So you have to make sure that for this shape to be considered a tick, the tail should always retrace more than 100% to be considered a Nike tick. Okay, so in this case, we can see that it surpassed the 127 level, and that's why we didn't include it here because it's no longer valid. So it surpassed it, and then we are expecting it to hit towards our 161 level. So it reversed off of it, and then it hit it back down. Okay, here's a GIF to show you what exactly is going on. Okay, so we see price reacting off of the 161.8 level, and it's heading back downwards. So that's basically what we are looking for, or rather we're looking for reversal when we're using this Fibonacci extension. Okay, next let's move on to Fibonacci projection. So projection uses the tool Fibonacci projection on MT4. Okay, no. So if you're using TradingView, this is the Fibonacci extension tool. So this is wrong, it should be Fibonacci extension. But in this case, we are referring to the Fibonacci projection because it uses 3 points. So the only difference between this and the previous 3 techniques is that this uses 3 points instead of the usual 2. Okay, so for Fibonacci projection, we take note of 61.8%, 78.6, 100%. And these other levels we use as supporting arguments for Elliott wave or for harmonics as well. And for Fibonacci projection, we are looking for a flash or zigzag type of shape as well. So that's why for Fibonacci projection, we often use this together with our previous technique, which was the expansion, since they both use the flash shape. Okay, so here's a simple example. You can clearly see the starting, middle, and ending points here. And price has bounced off of the 100% Fibonacci projection level. Okay, so here's an example with a very obvious zigzag. So we want to take note of the trend line following the market structure closely. So the market structure is like this. Price is heading downwards and we're projecting our Fibonacci extension to hit towards this 78.6%. Okay? So now let's see how this plays out. So you can see price bounced off the 78.6% Fibonacci projection nicely, according to our previous analysis. Okay, here's another example. Once again, we have this lightning bolt shape. We use 3 points, and we're taking note of this 100% Fibonacci projection. And this is so price hasn't reached this level yet, and it's a projection to the future. That's why we call it Fibonacci projection. Once again, this is how it plays out. It hits towards the 100% and it reverses off nicely and hits back down. Okay? Okay, so what makes an invalid Fibonacci retracement? So this is one of the most common scenarios, and it's when price makes a lower low. So assume you are drawing a Fibonacci retracement from the top to the bottom, okay? If there are bars on the right that break your ending point, it then becomes invalid. And there are Fibonacci retracements that are negative, but those are not applicable in this situation. Okay, let me show you the example. So we can see price has a starting point here, ending point here. Now that price has broken below the 0% level, it's no longer valid to be used as a retracement. So that's basically what we mean. Price breaks our ending point on the right, and hence we cannot use this ending point. So you want to always remember to pick the lowest point with nothing on the right of the ending point. Okay? Okay. So I briefly mentioned earlier that it's important to follow the market structure or the shape of the chart. And yeah, I'm just going to go through some examples on this. So firstly, we want to make sure that the swing highs and lows that we're using are significant and not like this. Okay. This is what you want to be looking out for when you are determining which charts to use. So if you're deciding between the different timelines, apart from deciding what kind of trader you are, so if you're scalping, of course, you'll be using a lower time frame. And if you are swing trading, you would use a longer time frame. So apart from that, you also want to make sure that your market structure has really clear and significant swing highs and lows. Okay, another wrong example here. Here we're looking for a zigzag shape, okay? But this we're not looking for zigzag shape, we're looking for a retracement here. Okay, but you can see because of this zigzag shape, we should not be looking for a retracement because it deviates too much from the market structure. Okay, so another example. This is the correct example of what you should be looking out for when you are looking for your Fibonacci trend lines. Okay, so now let's get back to a couple of harmonic patterns. Okay, so let me know in the chat how many of you guys use harmonic patterns. I'm just curious to know. But harmonic patterns are quite complex and quite technical to understand. But once you understand the pattern structure, they can be spotted pretty easily. So these patterns are either forming or completed M or W. And these structures are combinations of that same shape, M or W over here. So all primary harmonic patterns are 5-point patterns with points X, A, B, C, and D. So I didn't label it over here, but we'll see in the next few slides. So price swings between these points are interrelated and have harmonic ratios based on Fibonacci. So if you take a look at this example, the simple M yeah, so double top and double bottom. So there's different names for these shapes, of course. But yeah, so some of these can be considered to be Elliott wave shapes as well. Just a couple, not all. And yeah, there are different names as well. Yep, head and shoulders as well, wedges and pennants. So we'll go through a couple of those shapes as well in the next couple of slides. Okay, so the most basic patterns, apart from those that I went through at the beginning of this webinar, would be the M and the W, or the double top or double bottoms. So for double top, we're looking at a simple M. Okay, the circles is where you would enter potential entry points for your trade. Okay, if we're looking at an extended M, your second hit would be significantly higher. Okay, and how you determine when to enter would be at this reversal here, or actually at this once price has retraced back to this level here. Okay, because if you look at it from a chart perspective, so if you imagine that these are candlesticks, this is a swing low and price is breaking out of it. So this is what we call a pullback support, pullback resistance. Okay, so this pullback resistance means that we're expecting price to retrace and hit back to it. So it's a significant level, and that's why this is a potential entry point. So same idea for this short formed M. Okay, if once price retraces this level here, once again it's a pullback level and we can expect price to retrace it. So that's why this is a potential entry point. So similarly for the W's, so this is a double bottom. So I think some of you guys would recognize that. And if we're looking at a short form W, the entry point is here because price has surpassed this this swing high. Okay, it's surpassed it and it's now become a pullback support. Okay, so we're expecting price to retrace it, and that's why this is our entry. For an extended W, same thing. Once price surpasses this swing high, then we go in for the trade. Or when there is a reversal over here. Okay. So this slide goes into depth, the specific times and targets for a W bottom and an M top, but I'm not gonna get into that. Okay, because we have a couple of examples to go through. But you can let me know in the chat if there are any questions. Okay, so here is our 5-point pattern example. So they all have a very similar structure. So if you notice from the M's and the W's and also this shape, they're all pretty similar. So the only way they differ is by their ratios, and that's how you use to identify them and locate their keynotes. So what I mean by keynotes is all of these points here, the X, A, B, C, and D. So a 5-point harmonic pattern has a critical origin X over here, and that's followed by an impulse wave XA here. This is followed by a corrective wave to form the I of the pattern at B, so over here. So the corrective pattern is the purple lines that I've highlighted. Okay, and it completes the AB leg, followed by the trend wave BC, and finally it completes the corrective leg once again at CD, and that ends around the potential reversal zone. Okay, I've included the Fibonacci retracement levels as well. I'm not sure if this presentation is available as hard copy, but it is being recorded, so maybe you can find it on YouTube. Okay. Yeah, so I've included the Fibonacci retracement levels as well, so that you can take note of how much it should retrace before you can consider it a significant level. Okay, here's another example. A possible pattern formation is identified after the first 3 legs, XA, AB, and BC are completed. Okay, so a potential trade setup is recognized at the last leg, so CD. Once it starts to develop, so you can see the dotted lines, it hasn't been fully developed yet, but how we determine that is based off of the Fibonacci levels. Okay, and this is also what we call the potential reversal zones. So Fibonacci ratio extensions, retracements, projections, and all of that are used to determine this PRZ. All harmonic patterns have a clearly predefined PRZ, and the initiation of new trades should take place in this zone and only after price reversal action. So that's why I said earlier that we'll only go in for we'll only enter a trade once either between here, this reversal here, or once price has surpassed this swing low here. Okay, so in this case, we have taken note of a projection, retracement, and another projection. And yeah, so the levels are just 161.8, 88.6, and 261.8. But it really depends on what pattern exactly you are looking out for. So okay, so let's get into the first pattern. So the first pattern we have the Gartley pattern, and this is first outlined by H.M. Gartley. Okay, and this is probably the best known harmonic pattern. After the impulse wave XA, the corrective leg should end at 61.8% retracement of XA. Okay, next, the point C, so over here, this pattern or rather this point, falls anywhere between 38.2 or 88.6% retracement of the corrective leg AB. So I've highlighted here, this C should be between 38.2 or 88.6 of AB. Okay, and this includes all harmonic trading ratios that fall between these two constraints. So it can be 50%, 61.8%, 70.7%, or 78.6%. Okay, and the pattern is completed at point D, so over here, and that's where we go in for the buy. And we want to make sure that point D is located between 127.2 or 161.8% of BC. Okay, so the retracement should be this amount. And it should also be a 78.6% retracement of XA. And that defines the PRZ, or potential reversal zone. Okay, long positions should be considered after a clear bullish reversal with a stop loss placed below this zone. So the zone would probably be about here, this area here. Okay, so where exactly should you place your stop loss? You want to make sure that you're placing your stop loss below that area. So target 1 for this pattern is at 38.2%, retracement of AD. While target 2 extends towards the 61.8% retracement of AD. So AD is just an invisible line here if you place your Fibonacci levels, Fibonacci trend lines here. Okay, now if we take a look at the bearish Gartley, of course it's just the opposite of the bullish Gartley. So after the impulse bullish wave, bearish wave, XA here, the corrective leg should end 61.8% of XA. Point C, excuse me, point C falls anywhere between 38.2 to 88.6 of the corrective leg AB. And similarly, it includes all harmonic trading ratios that fall between these two constraints. So like 50%, 61.8, so on and so forth. How far should we expect E to be? Okay, by E, I'm guessing you mean our take profit, right? So you can place it below this area here. The reason for that is because these this swing high here at point A, if we're looking at the bullish Gartley, this point A is considered a swing high. So we can expect price to hit back towards this level here, especially if we have previous points that all line up nicely, or we have other Fibonacci levels that line up, because then that makes it a confluence area. So price is likely to be attracted to this confluence area here, but we want to make sure that we place your take profit or point E below that confluence area. So you can place your level slightly below it. And the reason for that is because areas of confluence tend to have, price tends to reverse off of such areas of confluence. Okay, so you might find yourself in a situation where you place your take profit exactly at this level here, and then price reverses and you're not able to catch that level by a couple of pips. Okay, so in order to make sure that you really catch this price before it reverses, then you make sure you place it below any confluence areas or before any confluence areas. So similarly, if we're looking at the bearish Gartley, we're going in for a sell. So your take profit would probably be above this area, above the A. Okay? Yep, no worries. So short positions should be considered after a clear bearish reversal with a stop loss placed above the potential reversal zone. So in this case, you want to make sure your stop loss is over here. So you could place it at X or actually slightly above X here. So since we're talking about where exactly we should place our take profit and stop loss, we typically would place it beyond it. Okay, and that's because you don't want to get stopped out when price reverses, which tends to happen quite a bit. So when if price breaks out of this area just a little bit, okay, instead of reversing off like we expected to, you want to make sure that your stop loss is beyond it so that you can still catch any reversals towards your take profit and you don't get stopped out before that reversal happens. So that's the idea behind placing your stop loss beyond a confluence area or any specific levels. Whereas for take profit, as I mentioned earlier, you want to place it before any specific levels or confluence areas. Okay, yeah, that applies for everything, not just harmonics, not just for Elliott waves, but yeah, it's just for any trades that you are putting in. Okay, let's move on to the next pattern, which is the bet pattern. And this is typically considered to be the most accurate pattern. So if we take a look at the bearish bet first, after the impulse wave XA, the corrective leg should end at either 38.2% or 50% retracement of XA. So basically point AB should be 38 to 50% retracement. But 50% is the most ideal. Point C would fall anywhere between 38.2 to 88.6% retracement of the corrective leg AB, and the pattern is completed at point D that will be located in the PRZ. So just basically this area here that's highlighted in pink is considered your PRZ. And long positions should be considered after a clear bullish reversal from C, or in fact from B if you want to be extra safe, and with a stop loss that's placed below the potential reversal zone. Target 1 for this pattern is at 38.2% retracement of AD, while target 2 extends towards the 61.8% retracement of AD. Now if we look at the bullish bet, okay, it's just the opposite. Okay, but maybe I'll just highlight that short positions should be considered after a clear bearish reversal with a stop loss placed above the potential reversal zone. Okay. Okay. Next we have the cipher pattern. So for the cipher pattern, we have XA and we have AB that retraces 38.2 to 61.8 of the initial leg. Okay, and once again, this includes all of the harmonic ratios that lie between these two numbers. Off the top of my head, I think it's only 50%. So it includes 50% as well. And then for BC, it retraces 127.2 to 141.4% of the initial leg as well. Okay, and then the last leg CD just retraces 78.6. For bearish, it's the opposite. Okay, I will show you guys in the next slide what it looks like on an actual chart. Okay, so we have this XA retracing, or rather AB retracing XA, and we have a 46% retracement. Oh yes, okay, so we have 50%, we also have 46% here. So yeah, 46%. And then from your BC, we have a retracement of 1.255, and then from B to D, retracement of 1.55, and your last leg from C to D retraces 78.1% of your initial leg. Okay, so this is pretty difficult to identify because the levels aren't your typical Fibonacci levels that we mentioned for the different techniques. So it might be a little bit more difficult to identify. Okay, this is what it looks like on a chart. Okay, next we have the butterfly pattern. So this is a pretty common pattern as well for harmonics, but the butterfly pattern requires a retracement of the impulse leg XA by precisely 78.6. Okay, point C can retrace anywhere between 38.2 to 88.6, including all the ratios that fall between these two constraints. And the pattern is completed at D, and this is located between 161.8 and 261.8 of your initial, not the initial, of this BC. Okay, so this is a projection. This point D is also a 127 to 161.8% projection of your initial leg. Okay, and yeah, that's the potential reversal zone. So long positions, if we're looking at the bullish butterfly, we are expecting prices to go up. So any long positions should be considered after a clear bullish reversal with a stop loss placed below here. So below D. So if it's going upwards, we can expect it. We'll probably only go in for a buy if you want to be extra safe after it surpasses this level here. Okay. Next we have the crab pattern. So the crab pattern was actually released in 2001, and this is an extreme pattern, and I'll show you guys why. So it basically uses extremely high Fibonacci ratios. So you can see here, the corrective wave AB is between 38.2 to 61.8% of the initial leg. So that's pretty normal. But point C retraces anywhere between, or not point C yet, point D. Okay, point C retraces anywhere between 38.2 to 88.6 of the corrective leg AB. So that's also pretty normal. But at point D, which is here, the potential reversal zone, we see that it's located between 261, here it's 224 or 22.4, but it can be between 261.8 to 361.8 projection of BC. Okay, so that's a really big ratio that we typically won't look at. So if you're looking at a bullish crab, similarly, long positions should be considered after a clear bullish reversal with a stop loss that's placed below here. Okay, and we have the last pattern, which is a sharp pattern. So if you guys know more patterns, there are, yeah, that's There's really a lot of patterns out there, but I only have 1 hour to explain a few. So you can go online and take a look at others, but these are the main few that we like to use. So in a bullish sharp pattern, after the impulse wave XA, the corrective leg should end between 38.2 and 61.8% retracement of the impulse leg XA. Okay. Okay, in this picture, it starts from 0 and it ends at C, but you guys kind of can imagine that this is X, A, B, C, and D. Okay, so point C falls anywhere between 113 to 161.8% projection of the retracement leg AB. And the pattern is completed at point D, in this case point C, and this is located at the potential reversal zone around 161.8 to 224% of the projection of BC, or in this case AB. Okay, if we're looking at a buy, long positions should be considered after clear bullish reversal, so off of this level here, and your stop loss will be placed here. If we're looking at bearish, your stop loss will be placed here. Okay. So there are two targets over here to make things easier. Target 1 for this pattern is at 38.2% retracement of CD, or BC in this case. 38.2% retracement of CD, while target 2 extends towards the 61.8% level of CD. Okay, now let's take a look at some advantages and disadvantages of using harmonic patterns. So harmonic patterns provide future price projections and stop loss levels in advance and are also considered leading indicators. They are frequent, repeatable, reliable, and produce high probable setups. And their trading rules are relatively standardized using Fibonacci ratios, and that's why it's important for you to make sure that you understand the Fibonacci techniques. And they work on all time frames and all market instruments. Other momentum indicators like CCI, RSI, MACD, DMARC, and so on can also be used along with them. Disadvantages: harmonic patterns are complex and highly technical to understand and master. So correct identification and automation or coding of harmonic patterns is difficult. So we're talking about if you want to try and backtest your harmonic strategy. It's quite difficult to do so. Conflicting Fibonacci retracements and or projections make it difficult to identify the reversal or projection zones. And complexity arises when we get opposing patterns from different time frames. So the risk and reward factors from some of the patterns are also pretty low. So yeah, just some disadvantages for you to consider when you are thinking of using harmonic patterns. Okay, and that's it for today's webinar. Let me know if you guys have any other questions. If not, thank you guys so much for being here, and I hope you guys learned something. Have a great rest of your week, and yep, see you guys again. Bye. Thanks, Risa. Thanks, everyone. Bye. Thanks, Ellen.